Right, kia ora, year 13s, it's Ms. Mac here. So I'm doing another go here. My microphone stopped working. So I'm just going to go through price elasticity of demand. Please don't watch this until you've actually had a go at, like, as I said, reading the textbook or just the workbook and making the notes yourself and just, trying to figure it out for yourself. And then you can watch this just to kind of like help you, did I get it correct? Do I understand it? So price elasticity demand is a really big focus for us. I do intend on assessing it, whether that's a class test or part of a report. Well, we'll have to see. And it does come up in one of the externals. Actually, it sort of could come up in both, but market equilibrium and allocative efficiency. There's usually one question there. I mean, I don't know if you really care about this right now, to be fair, but there's usually one question, and it's kind of like an excellence question. And of course, if any of you are still considering scholarship, which is still going ahead at this stage, it could be definitely something that would come up and be relevant. So it just is the same as PES, price elasticity of supply. It's about the responsiveness, that word again, of quantity demanded this time to a change in price. And obviously we're looking at demand now, so the relationship is negative. Whereas price increases, the quantity demanded decreases, so they go in opposite directions, whereas supply has a positive relationship to price. Price goes up, quantity supply goes up. So this is negative. And what we're looking at now is we know it would decrease. Well, will it? That is a question. But the price will increase and the quantity demanded will decrease, but by how much? So how much will quantity demanded decrease when price increases? And I did say should, because sometimes the price could go up and the quantity demanded won't fall at all, i.e. it's something that people really, really want, and they're prepared to pay whatever to get it. And in these current times, I think we could think of many examples of what that could be. So moving forward, the same wording from when we looked at PES. Okay, but please pay careful attention. So elastic means it's very responsive, and the word you're looking at is that there's a proportionately greater. So if I was to ask you to explain, for example, what elastic demand means, I'm looking for you to talk about proportionately greater decrease, or it could be an increase, in quantity demanded when there's a change in price. All right, so do watch your wording very carefully. This is something that some of you will have to work harder on than others. But in year 13, we're quite technical in terms of our concepts and what exactly it means. So you do need to use the word proportionately greater to describe the idea of elastic demand. Inelastic is it's not very responsive, again, that wording, as an increase in price will lead to a less than proportionate decrease in quantity demanded. And if it was an increase, a decrease, less than proportionate increase. Unitary, as just like before, this time if there's an increase in price, you get exactly proportionate decrease in quantity demanded. Okay, now I understand again that this is all like, well, what does that mean? So here's some examples for you. Similar to before about potatoes, quantity demanded this time would decrease by a much greater percentage. So percentage is like proportionate, increase by 10% proportionately greater and decrease in quantity demanded. Burger fuel right now, like if they hadn't had to shut, but like say yesterday, huge demand and they knew that they could increase their prices to take advantage of that, and they thought let's increase it by 2%. They're already quite expensive burgers and they're kind of like a luxury takeaway. So if they were to increase their burgers, we could expect to see quite a large decrease in quantity demanded, a greater than proportionate decrease in quantity demanded, say 20%. Paracetamol is like a really must-have necessity now, especially if you do unfortunately get sick with coronavirus or any cold. I still have a sore throat. The price could go up, say 10%, and the quantity demanded would decrease by a really, really small amount, say 1%. So that's a proportionately less than responsive. That doesn't make good English. Is a proportionately smaller decrease in quantity demanded. Petrol, I think you can see these ones are kind of, this should make sense to you. Petrol increase by 1%, the quantity demanded decreases by 0, so no change. People just keep on buying the petrol. Cigarettes, imagine like those tax increases that the government puts in to make them more expensive. They increase by 20%. And you have a proportionately smaller decrease in quantity demanded. I'm not going to deal with like what affects elasticity today, but I think there should be some obvious ideas coming through in terms of what makes people basically sensitive to price changes or not. This is what elasticity is. It's about sensitivity to price changes. Unitary, what we're looking at is, sorry, just telling someone to be quiet. Price of pens, I was just thinking of an obvious good here, I don't know, like something that people are not particularly concerned about, worried, sensitive or not. Price goes up by 10% and the quantity demanded goes down by exactly the same percentage. So this is what it means in real terms. What does it look like? So if you're asked, like, I'm looking at the market for milk, for example, what kind of elasticity do I think it is? And this is something really important for government decisions regarding like policy to try and encourage people to drink milk, for example, or not drink milk. They need to know what the elasticity is. And one way you can sort of get a clue as to the elasticity is to look at the demand curve. So if it's quite, I think this is a particularly great example here. Oh, this is unitary elastic. If it's kind of like a demand curve that's sort of straight through the middle there, it's what we call unitary, isn't it? It has a perfectly responsive, like it's proportionate every time to a change in price. Whereas if it's quite flat, and this is perfectly elastic, so it's exactly horizontal, but imagine like a demand curve like this, kind of anywhere kind of flattish. It's, still diagonal, but it's quite flat, then it's elastic. They're quite sensitive to changes in price. But this is perfectly inelastic, so it's completely vertical, which means that you could increase the price like heaps, but you aren't going to change your quantity demanded at all. And this would probably be something you're addicted to, or it's an absolute essential necessity, like, for example, the vaccine for coronavirus. And if it was kind of inelastic but not perfect, again, you'd have a demand curve that's quite steep. So the word steep, demand is quite steep. This could be like alcohol, well, not alcohol, but maybe like cigarettes. Alcohol right now for perhaps some people would be kind of inelastic. It would be quite steep, that a change in price would lead to a proportionately smaller change, or if it's an increase, a decrease in quantity demanded. So again, that heavy thing comes in. If it's horizontal or flattish, it's elastic. If it's vertical or steep, then it's inelastic. And if it's just exactly, in case this straight, perfectly responsive, then you have unitary elasticity. Okay, so how do we calculate it? Oh, again, I see a mistake here. Let me change. Kia ora, year 13, sorry. PED, not PES. So price elasticity of demand is the same. We use the same calculations as price elasticity of supply. There's one little bit of a difference. I'll get to that in a moment. In midpoint again is the one that we prefer for NCA because it's more precise, and so you can see that if you use the percentage change, and I go back to my graphs here, too far. If you're looking at the whole curve, like from here to here, the whole thing, then you could use percentage change. If, however, you want to look at a particular point, between two particular points and see what the elasticity is, then you use the midpoint. And the midpoint is the one that we use because we're looking at particular changes in price between, 2 points. And the reason, I'll just elaborate here, particularly with demand, elasticity can change. And we sort of see examples of that when you've got like a good that's kind of quite cheap and you're looking at it's like $1 and you're looking at a 10-cent price increase or something like that. You probably see quite inelastic demand in that people aren't particularly sensitive. They're kind of like, like say matchboxes. Oh, it's gone up 10 cents. Oh, never mind, I'll just pay. Like they might even notice. Whereas if you then see the price increase from say $1.10 to maybe like, it's already $2, $2.50, and it goes up to say $3, then you could see more sensitivity and a much greater response in terms of quantity demand falling. Chocolate bars might be an example that if, you're only paying like $1 and it went to $1.50, you're kind of like, oh yeah, I don't really mind. But if it's like $3 and it's going to like $3.50 or $3.20 or something like that, same like price increase maybe, you might see a much bigger response in terms of quantity demand, and people are like, oh, I don't want to pay that, and so they drop their quantity demand by quite a lot. Okay, so the formula is the same. The key thing again is working with this. All right, so brackets, quite important, and you can change this formula up. It's a little bit different in your textbook, I think, from memory, but yeah, we'll have a go with it. What you get, the coefficient, again, that's just like the answer, that the number, or the decimal actually in the end, is quite important. So if it's over 1, again, it's elastic, and it could be any of these things. If it's a number under 1, but not less, maybe we'll talk about negatives later. If it's like 0 to 0.95, that kind of thing, it's inelastic. And then you've got those ideas of perfectly elastic, okay, is horizontal, infinitely responsive to changes in price, and 0, which is it won't change at all. Okay, so let's have a look at practicing this. Now, these are in your workbook, page 12, and these examples are on page 12, but there's more on page 13, and Mr. Moore has done a little revision quiz for you, which I would like you to do. So have we go at this. first yourself, use those formulas, and again, particularly for A and B, show where you're working, and pause this video now, do it. Okay. All right, now where hopefully you've had a go at that yourself and you've come back, or I'll accept that you had a go but you just got stuck and just needed a bit of help. All right, that's fine, because there's more examples for you to do in your workbook. I have lots more examples, but I just kind of want to get you started for now, and if you do want more practice with this, then just let me know, although we'll just kind of see how the course develops, in terms of, because if we do this later, we might need to practice this, like revise this concept after we've learned a bit more. So good A, here is how we do it. So I'm breaking it down. I'm not going to read through of it because I'm mindful to keep this video to 15 minutes, but break down your quantity situation. I tend to do that first. All right, so the change in quantity demanded always on top, quantity 1 plus quantity 2 divided by 2, brackets really important, and then, changing quantity over that bit, so that bit first, I do that, and then I work out the price situation. All right, so I'm changing price divided by price 1 plus price 2, yep, so all of that, and again, so to break it down like so, I do that, then I do that, and then I do that, and divide it by that. Now, that gets 0.9. It's a little bit different to your text, your workbook answer. I think we're talking really minor difference here, like I think this is 0.75. You can see that's clearly inelastic because it is less than 1. Okay, so this is what you're going to know this. You will know this. If it's less than 1, it's inelastic. If we are doing a test in class, you'll get a cheat sheet. So I'm not that cruel. Okay, but however, that's what it means. Percentage change, I just wanted to show you that you do get a slightly different number. It's slightly more inelastic. And those of you who can't remember how to do percentage change, you can rewrite this formula any way you want. Second number minus the first number over the first number times 100. Yeah, I'm not a mathematician again, please be kind. I'm trying to teach you maths here, I guess, and I may not be brilliant at it. Looking at the other example B, all right, so again, I do the quantity situation first. I kind of break it down like so. So I do this, do this, do this, then divide this by this, yep, and get that, and then I do this. So I do this bit first, and then I divide that by that, and then I get that, and that's my answer. Now, I'm going to tell you that when I actually was typing up the working here, I actually made a mistake. I forgot to put the, extra 0 here, so it was 0.74, and I was like, why is that in it? I don't think that's inelastic. So you do need to be really careful if you're working. All right, a simple mistake like that might give you quite a different answer, like say it's inelastic and it's not, so like 0.25 instead of 2.5. So check your working really carefully. I did the percentage change method again just to kind of show you that there can be a slight difference, and you can see it's slightly lower, so slightly less elastic. And how do I know it's elastic? Again, you will just know, you'll learn this. If it's over 1, it's elastic. And being 2.5, it's relatively elastic there. Okay, looking at the other example, it's just percentage change. You could only use percentage change with this one because you don't have any more figures to work with. So in this case, 3.1% divided by 2.5% equals 1.24. We're looking at a slightly elastic good here. All right, so things to consider. The other way of calculating elasticity is to well, you're not so much doing a calc, you can just see this. Is look at the revenue, the change in revenue. Okay, so if you have a good that's elastic, what you're going to see is that if you increase the price, you'll get a decrease in revenue. So if you're looking in a situation, you calculate the revenue before and after, and you see that it's decreased after you increase the price, then you must have elastic demand. Okay, or another way of thinking of it is if you have elastic demand and you increase the price, your fall in sales is going to be quite large and you're going to find that your revenue falls. If, however, you have inelastic demand and you increase your price, what you're going to see is that your revenue will actually increase. So it's kind of like a really good thing to know if you're going into business, hint marketing, price marketing decisions, kind of knowing what you can get away with. If you think about this, unitary, like that's kind of good to know because it means that you can get away with increasing the price and it's not going to affect your revenue. If we look at it in the opposite thing, should I do price marketing? Should I drop my price? Not if you have inelastic demand. If you drop your price and you have inelastic demand, then you're going to actually get a fall in revenue. Okay, so it's not a good idea. Whereas if you have elastic demand, your customers are really price sensitive, so dropping your price is a good idea. You're going to lead to a greater than proportionate increase in sales, which will increase your revenue. Okay, so really it will be important. It has a lot of implications for producers and their marketing decisions, but it's just another way, like if you don't have other information, how do I know if it's elastic or inelastic? See what happens to the revenue when the price changes. Okay, so I hope this has been helpful. I'll post it up now. Ka kite and stay healthy.